Hi, welcome back to Joe Blogs. In today's episode, I want to provide you with an update as to what's happening in China. China is the second largest economy in the world and is the biggest manufacturer. So what's happening in China has a big influence on the global economy, and the data that's now been released for July shows that China is continuing to struggle. Exports, which are the lifeblood of the Chinese economy, are down 14.5% year on year, and this is now the 8th month out of the last 10 that China has seen a fall in its exports. So this represents a very serious problem. But it's not just exports that are a problem. Imports were also down 12.4% in the month, which is the 9th month out of the last 10 that China has seen a fall in imports. And the reason that the fall in imports is such a problem is that China imports a lot of commodities and raw materials, which it then uses in the manufacturing process to produce all of its goods to export. So when imports are falling, that gives us a strong indication that exports are likely to fall over the next few months. So this is becoming a really vicious circle for the Chinese economy. And partly as a result of the fall in exports and imports, the Purchasing Managers Index, which gives us a strong indication as to what's happening within the companies in China, continued to be below the critical mark of 50 in July, which tells us that the companies within China are now worried about what's going to happen for the rest of 2023. And to make matters worse for China, the economy is now struggling with deflation. So this is the opposite of inflation. China is now seeing prices falling. And as a result of all of these factors, the value of the Chinese yuan is also falling in the international markets. So in today's video, we'll go through the details of what's happening with exports and imports. We'll have a look at the Purchasing Managers Index. We'll talk about inflation and the Chinese yuan. And then finally today, I'll wrap up with my summary. So what I think is likely to happen in China over the course of the next 3 to 6 months and what the implications of this are for the global economy. This chart shows the year-on-year movement in the value of China's exports over the last 12 months. And the scale on the right-hand side of this chart goes from positive 15% at the top to negative 15% at the bottom. And if we start off by looking at the situation for July 2023, you can see that on a year-on-year basis, the value of China's exports fell by 14.5%, which is the fastest rate of decline that China has seen at any time in the last 12 months. And in fact is the worst performance that China has experienced since the start of the COVID pandemic in 2020. And as I mentioned at the start of the video, the reason that this is such a major concern for China is that exports are the lifeblood of the Chinese economy. The strength of the Chinese economy is based on manufacturing goods, which it then exports to the rest of the world. And if we look at the trend as to what's been happening over the last 12 months, you can see that the fall in July is not a one-off event, as China has seen a fall in the value of its exports in 8 out of the last 12 months. The decline in the value of exports started in October 2022, when China saw a minor fall of 0.3%. That fall accelerated in November to 9%, rose to just short of 10% in December, and increased further to 10.5% in January. Now, following the removal of the COVID-19 restrictions, under which China had been continually locking down major cities in December 2022, it was expected that in 2023, the Chinese economy would see significant growth. And in March and April, we did see a reversal in the fall in exports. However, unfortunately for China, that reversal was short-lived. And in May, we saw a fall in the value of exports of 7.1%. That increased to 12.4% in June, and we've now hit 14.5% in July. So you may be wondering what's causing this major fall in the value of Chinese exports. Well, the reason is a combination of a fall in demand in China, so home demand, combined with a fall in demand for Chinese goods from other countries. Exports to the United States, which is the largest market for all Chinese exports, fell 23.1% year on year in July, while shipments to the European Union fell 20.6% as diplomatic tensions mount over chip technology and de-risking from China. So the fall in the value of China's exports is a combination of a general weakening in global demand as we've seen economies starting to move towards recession and slowdown, and also a deliberate policy from some of the bigger economies to stop buying Chinese goods to reduce the exposure that they have to China. And once again, if we take a step back and look at the trend as to what's happening, there is a clear downward momentum here. If you were to draw a trend line across these bar charts, it indicates a strong downward momentum and tells us that things are going to be very challenging for the rest of 2023 for China. But as I mentioned at the start of the video, China is the second largest economy in the world. And it's not just exporting goods, it's also buying lots of goods from other countries. So if we're seeing a slowdown in the Chinese economy, it's likely to have a large knock-on impact to the global economy. So let's have a look at what's happening with Chinese imports. This chart shows the movement in the value of Chinese imports over the course of the last 12 months. And as you can see, in July, the value fell by 12.4%. And the reason that this is concerning is that China is importing lots of commodities and raw materials, which it then uses in its manufacturing processes to produce goods to export. So the fact that the value of imports is falling gives us a strong indication that there is a slowdown in the Chinese economy. They're producing less goods, and therefore the problems with exports and the overall economy are likely to persist. And if we take a step back and look at what's been happening to the value of imports over the course of the last 12 months, you can see that the problems with imports have been going on for a very long time, and the value has fallen in 10 out of the last 12 months. As we discussed earlier, the COVID-19 restrictions were removed in December 2022, and the removal of these restrictions was expected to boost the Chinese economy. However, if you look at the value of imports, you can see that that boost was very short-lived, and it only resulted in a very short-term increase in February, and since that time, the value of imports has fallen in every single month. And once again, if you look at the trend here, you can see that there is clear downward momentum. And this tells us that the problems in China are likely to continue throughout the rest of 2023. And one very interesting point to note about China's imports in July is that the value of imports from Russia reduced by 8% to $9.2 billion, compared to an increase of 15.7% in June. And this fall is the first monthly decline in the value of imports from Russia since February 2021. And if you've been following the channel, you'll be fully aware that since Russia's invasion of Ukraine started in February 2022, Russia has made a concerted effort to increase the value of its exports of oil and natural gas to China as a direct result of the loss of trade from the West as a result of the sanctions that have been applied against Russia. So the fall in the value of Chinese imports from Russia represents a fall in demand for both oil and natural gas as a result of the slowdown in the Chinese economy. And what this demonstrates is that the slowdown of the Chinese economy will have a direct impact on a lot of other countries, including Russia, who are now more dependent on China than they ever have been. This chart shows the movement in the Manufacturing Purchasing Managers Index for China over the course of the last 12 months. Now, if you follow the channel, you'll hopefully be perfectly familiar with the PMI. But for anybody that hasn't seen this index before, the Purchasing Managers Index is a globally recognized survey that's taken amongst thousands of different companies in countries all around the world to give an indication as to what's happening with regards to business confidence. So basically, purchasing managers, who are the guys who are buying in raw materials and other goods that they need to produce all of their finished articles, are interviewed and asked whether or not they're increasing their purchases, whether or not they're more confident about what's happening in the future, and a variety of other questions. And the data that's provided from these surveys is then evaluated to produce an index which tells us whether business confidence is rising or falling. And the key score for this index is 50. A score above 50 tells us that confidence is rising, that purchasing managers are buying in more goods, and that they're expecting their businesses to expand. However, if the score is below 50, then that tells us that everybody is more cautious, they're starting to contract, and the purchasing managers are not confident about future growth. And the latest data coming out of China shows that the PMI for July is 49.3, which is below that critical 50 mark, and tells us that businesses in China are cautious and they believe that there is likely to be contraction over the course of the next 3 to 6 months. And in fact, the data here follows a very similar trend to what we've just looked at for exports and imports. The index fell to 49.2 in October 22, fell further to 48 in November and 47 in December. There was a bounce back in January, February and March when the index actually rose above 50, and this correlates to the period when the COVID-19 restrictions were removed and everybody was confident that China was going to have a very strong 2023. However, the index once again fell below 50 in April and has remained below the critical 50-point mark in May, June and July. So once again, the overall summary here is that China has been struggling in terms of business confidence for the last 4 months, and purchasing managers are not expecting the rest of 2023 to result in boom times for the Chinese economy. This chart shows the movement in inflation in China over the course of the last 12 months. So as you can see, back in July 2022, inflation was running at 2.7%, which is considered to be a healthy rate of inflation. Most countries around the world have a target rate of between 2 and 3%. And the reason that most governments set inflation targets at around those levels is that it allows an element of growth. If you're a company, you want the flexibility of being able to increase prices, firstly to pass on any cost increases that you're incurring, and secondly to be able to increase the wages of your staff. So this time last year, the rate of inflation was exactly where the Chinese authorities wanted it to be. And in August, September and October, the rate of inflation stayed within that 2 to 3% bracket. However, in November, China experienced a contraction in its economy and inflation fell to 1.6%. It then increased to 1.8% in December and bounced back to 2.1% in January. Now, January was the first full month following the removal of all of the COVID restrictions that the Chinese authorities had imposed for 3 years. They were still putting whole cities into lockdown. And at that stage, it looked like the Chinese economy was going to bounce back strongly and that 2023 would be a very good year for China. However, as you'll be aware, the recovery didn't last as long as everybody expected, and inflation fell to 1% in February. It then fell to 0.7% in March, 0.1% in April. It increased slightly to 0.2% in May, and in June 2023, the official rate of inflation is 0%. So that means that on an annual basis, prices in China today are at exactly the same level as they were 12 months ago. And that is obviously bad news for all Chinese businesses because it means that they can't increase their prices. So they can't pass on any cost increases and they can't increase the wages of their staff without affecting their own profits. And if you take a step back and look at the trend of this chart, you can see that in 2023 there has been a sharp downward trend in the level of inflation. And if we extrapolate that trend throughout the rest of 2023, it's highly likely that China is now going to see falling prices. And of course, that will be a big challenge for all of the Chinese corporates, because if they've got falling prices, but their costs are going up, then that means that they will start seeing falling profits. And that's going to be a major problem for the Chinese economy. This chart shows the annual movement in producer prices in China over the course of the last 12 months. And producer prices are also known as factory gate prices. So these are the prices that companies are selling their goods for. And as you can see, back in July 2022, producer prices had increased 4.2%. In August, that level came down to 2.3%. And in September, it fell further to 0.9%. However, from October onwards, what we can see is that producer prices in China actually moved into negative territory. So producers were having to sell their goods at a lower price than they were 12 months previous. And obviously that is going to cause problems for any producer because most companies have rising costs and so they want to keep increasing their prices. If you have to start cutting prices, then generally speaking, it means that you're having to compete harder to win that business and it's likely to eat into your profits. So Chinese producers experienced a fall of 1.3% in their prices in October and November. The fall in prices actually reduced to 0.7% in December, 0.8% in January. However, in 2023, things have started to get progressively worse for Chinese companies. In February, prices fell by 1.4%. in March 2.5%, in April 3.6%, in May 4.6%, and the figures for June 2023 show that on a 12-month basis, producer prices have fallen by 5.4%. So that means that on average, companies in China are selling their goods today for 5.4% less than they were this time 12 months ago. And if we expand the chart out to show the position over the last 5 years, you can see that the current fall in prices is actually worse than it was during the COVID-19 pandemic in 2020. So that really puts into perspective how serious this situation is. This chart shows the movement in the exchange rate between the US dollar and the Chinese yuan over the course of the last 12 months. And as we've discussed before, the traditional way of showing these charts is that the stronger currency is quoted first. So that means that when we see an upward movement in these charts, it indicates that the dollar is strengthening and the yuan is weakening. And what this chart shows is that this time 12 months ago, $1 was trading for around 6.7 Chinese yuan. The exchange rate then fell to a low of $1 to 7.3 Chinese yuan by the start of November as the Chinese economy started to contract. However, in the first part of 2023, we saw a bounce back in the Chinese economy when the outlook started to look a lot more positive and everybody was expecting 2023 to be a super strong year for China. And by the middle of January, $1 was trading for 6.7 Chinese yuan. However, over the course of the last 6 months, we have seen a significant weakening in the Chinese yuan as the economy has started to slow down, and the current exchange rate is $1 for 7.2 Chinese yuan, which represents a fall in value of more than 8% over the course of the last 6 months. And I think the exchange rate is really interesting when you're talking about the Chinese economy, because China is a net exporter. It manufactures lots of goods which it exports all around the world. And when you're a net exporter, your exchange rate has a big influence on the amount of business you're doing. So let's talk about a practical example of a product that's being sold by China that's priced at 6.7 Chinese yuan. This time 12 months ago, that product would have been selling in the USA for $1. However, because the US dollar has now strengthened against the Chinese yuan, that same product priced at 6.7 Chinese yuan would be selling in the USA today for around 92 cents. So the fall in the value of the currency means that China's exports should become relatively cheaper in all of the markets it's selling into. So you would have thought that would be good news for the Chinese economy, because if things are cheaper, they should sell more and therefore make more profit. However, what we're seeing from the data is that that isn't happening. We've got disinflation in the Chinese economy, so prices are falling for Chinese consumers, but we've also got factory gate prices falling. So the actual price that goods are being sold at is going down at the same time as the Chinese yuan is falling in value. So what that means from China's point of view is that when they're selling all of their goods overseas, they're now receiving less foreign currency. Because in the example we talked about, the product that was being sold at 6.7 yuan was previously bringing in $1. However, today it's only bringing in 92 cents. And this means that China is now suffering on a number of different fronts. So what's the summary and conclusion today? Well, I wanted to post this video really to provide you with an update as to what's happening right now in the Chinese economy. And as you've seen from today's data, things are getting worse. The total value of Chinese exports fell by 14.5% in July, which is higher than expectations and is more than the 12.4% fall seen in June. So what we've got here is a continuation of the downward trend in exports, which means that China's total revenues are falling, and that is very bad news for an economy which is already struggling. The two main drivers for the Chinese economy are the value of its exports and its real estate market, and both are on their knees at the moment. If you've been following the channel, you'll know that there are major problems in the Chinese real estate market right now. And these problems have been going on for the last few years, ever since the Chinese authorities decided to introduce the 3 red lines and restrict the amount of debt that property developers were able to access. That meant that those developers were unable to finish a lot of the projects that they'd started. Some of the major Chinese real estate companies, which are amongst the largest companies in the world, the most famous being Evergrande, which has over $300 billion worth of debt, are on the verge of defaulting on their debt obligations. And unfortunately for China, its exports are also now in a complete mess. A year-on-year fall of 14.5% represents serious problems for the Chinese economy. And if we look at what's going on with the value of imports, it doesn't look like there's any end in sight, because the imports give us a critical indication as to what's going to happen over the course of the next 3 to 6 months. Because China imports all of those raw materials, which it then turns around through its manufacturing process into finished goods. And the value of imports in July fell by 12.4%. And that fall was significantly higher than both the market expectation of 5% for July and the 6.8% fall in June, and indicates that the problems in China are accelerating and that things are getting worse. And the data that we looked at from the Purchasing Managers Index backs that up. It tells us that the purchasing managers in China are cautious and nervous about what's going to happen for the rest of 2023. And unfortunately for China, the data that we looked at for both inflation and producer prices is also very worrying. China is currently sitting on the verge of deflation, and producer prices are actually falling. The factory gate prices are going down. So companies in China are having to sell their goods now at a lower price than they were this time last year. And that's going to further accentuate the problem, because Chinese companies will now be making less profit. They potentially will be making losses, and so they may need to start reducing their workforce, and this could cause major problems in the Chinese economy. And all of these problems are reflected in the value of the Chinese yuan. So taking a step back and looking at the big picture here, China is in serious trouble. The value of its exports is falling, the value of its imports is falling, business confidence is down, inflation and factory gate prices are falling, the value of its currency is down, and the outlook in terms of what's going to happen over the course of the rest of 2023 is negative. The global economy is still in difficulty. We've seen a slowdown in demand, and that's likely to cause further problems for China. But as I mentioned at the start of the video, China is the second largest economy in the world. So what happens in China has a big bearing on what will happen for the globe. And unfortunately, the contraction of the Chinese economy means that there will be less demand from China for exports from other countries. And so this will have a knock-on impact. It's highly likely that if China continues with its downward trends, that these downward trends will take the global economy with it. So this, unfortunately, is not just bad news for China, it's bad news for all of us. So hopefully you found today's video useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and here's something to put a smile on your face.